Right. Can we get started here then? Hi, everyone. I am Evan Foster. I will be moderating in lieu of Jeff Eliason from SDR Ventures, who has fallen sick. So I've been tapped in from Allie's Family Business Conveyance Solutions, where I am a partner and one of the senior consultants. We work with many family businesses, particularly on the post-acquisition phase, where we help the acquirers migrate and consolidate their ERP systems. And so I will be moderating this webinar as we go through. So for key speakers, we have Bob Dahl, a respected chief investment strategist at Crossmark Global Investments. Bob has vast experience in the industry, and he's a frequent guest on CNBC. He translates complex economic concepts into understandable language, providing valuable insights and for informed decisions. Next up, we have Scott Mitchell. He's a seasoned M&A advisor and capital market professional. As a managing director at SDR Ventures, he empowers businesses and advisors with insights into dynamic capital market trends to help make fully informed M&A decisions. Then last but not least, we have Dr. Allie Taylor, an expert in the psychology of low to mid-market owners. Dr. Taylor helps her clients gain clarity, confidence, and control at points of significant transition. As a business psychologist, she works with owners to achieve transition success in the same way sports psychologists work with elite athletes to increase their performance. So with the introductions out of the way, Allie, would you like to give us a brief overview of why we're doing these webinars?
Yeah. Bob and Jeff Elias and I were at a dinner and having a conversation about what we could do to help owners be more successful in an ecosystem that is very siloed with advisors that aren't always thinking holistically. And so we decided that we would do a series of 3 webinars. This is the third in that series to give owners a perspective across 3 important domains: their financial investments, their business exit options, financial investments with Bob, business exit options with SDR Ventures, Scott and Jeff, and then their psychology and how we can help owners maximize their opportunities in both of those spheres by making their psychology an advantage instead of letting it work against them.
Great. And for a quick agenda overview, first we're going to talk about how low to mid-market owners face considerable challenges and uncertainty through the 2020 election, the global pandemic, supply chain crises, and the 2023 banking challenges. Now, the 2024 election cycle is looming. All of these environmental factors can cause business owners significant confusion, especially if they're considering an exit. So today, our discussion will provide clarity on what factors really matter as business owners consider the timing of their exit. So first, Bob will provide a financial markets and investments update. This will dovetail with a discussion on key factors in the macro environment and the impact of those conditions on low to mid markets M&A. Next, we will discuss how the performance of the business impacts the timing of the exit decision. And lastly, we'll discuss how the owner's needs and psychology influence their decisions during exit. So with that, let's start by giving Bob the floor to update us on noteworthy changes in the economic forecast, the outlook for the remainder of the year, and a first look at 2024.
Thanks, Evan. Hi, everybody. Thanks for tuning in. I've got 3 slides to try to accomplish all Evan just said, and I know he said with clarity. I don't know, with 5 hours, I still couldn't give you clarity. It's a crazy world out there, but let's try to put some rubric around it all. So I start with, from an investment standpoint, at a high level, the bull and the bear case. Now, let me walk through these briefly. The Fed, obviously the central bank of the U.S., is a key influencer for capital markets, for the economy, for business decisions. And the bulls would say, don't worry, the Fed's just about done, if not done. And if things deteriorate, they can turn around and cut rates. And the bears say, not so fast. We haven't brought inflation anywhere close to the 2% the Fed wants. And so rates are likely to be higher for longer. Inflation itself, the bulls are saying, well, we've brought it down from 9 to 4. What's wrong with getting it to 2? That should be fairly simple. And the bears say, not so fast. 9 to 4 is easy. 4 to 2 is really, really hard. And in fact, core inflation, wages, etc., has remained sticky. The bulls would say, we're going to have a soft landing. Everything's okay. The Fed's going to engineer this and get it right. And the bears would say, well, they haven't gotten it right very often in the past when they've had to tighten. And we're going to have, if not a significant economic slowdown, we're probably going to have a recession, a word that has left the vocabulary of many people who do what I do for a living. In terms of earnings, which moves stock prices and the economy over the long term, the bulls would say, well, revisions turned up. And the bears would say, yeah, they did for about 2 weeks. And we probably are going to have a drop of 10% in earnings if we're going to have a noticeable slowdown since a recession. And then the valuation story, the bulls say, yeah, we're a little above average, but they're reasonable given how good things have been and how low inflation's going to be. And the bears would say, not so fast. Increasingly, earnings are under pressure. Now, we could have a debate that lasted a couple hours on each one of these subjects, so I have certainly not done them justice. I would summarize by saying it's always uncertain out there, but I think for a bunch of reasons, the uncertainties are a little higher than usual. I lean toward the bear side of this, have in our first 2 webinars. I do the same now. The only thing that's worked in our favor since we did the first one is stocks have gotten a little cheaper because they've gone down. They're still not cheap, and we've had some deterioration fundamentals, not to mention a little war in the Middle East that's reared its ugly head. So let's move to the second slide, which is a very simple one. If I could only say one sentence for the economic outlook, it would be this one. There are consequences to raising interest rates from 0 to 5.25 in just 18 months. This is the fastest increase in interest rates anyone in the sound of my voice has ever witnessed. And the consequences of that, in my judgment, a lot of them are still to be felt. Those of you that know the capital markets well know that from the time the Fed starts raising rates to the onset of a recession, or the time from the inversion of the yield curve to the start of a recession, is long and variable. Averages are not real helpful here, but if you get averages on those 2 lead times, it's about now. In other words, we haven't had a recession, therefore we're not going to have one, is similar every cycle. You can go back and look at the discussions that take place prior to other recessions, and people would say, well, I hear all those negatives, but there's no recession. What are you worried about? And that's about the time it smacks us in the face. Now, I'm not trying to be a Cassandra here or be overly bearish. I'm just giving you realism and a little bit of history to help you think through the process. My last slide is a series of conclusions. If we could go there, Evan, there it is. I've touched on many of these if you tuned into our first 2 webinars. Some of them are repeats. We have said since early last year that a recession is likely to begin sometime around Labor Day 2023 and year-end 2023. We're obviously in that period. And of course, we get a lot of things wrong. It might not happen until early next year. But I think the National Bureau of Economic Research is likely to indicate that the recession started sometime in the 4th quarter of this year. Time will tell. Number 2, and on the other side of the coin, while the labor market is very resilient, it's beginning to show some cracks. You see that in the number of people working 2 jobs, et cetera. I could go through a lot of detail there. Number 3, I've already hinted at this. Inflation is a significant problem and is not falling fast enough. There's a big difference between 4% inflation, where we are today, and 2% inflation, where the Fed would like it to be. And therefore, number 4, the Fed is likely to follow a higher for longer path. Bonds, among the catalysts for the decline in the equity market these last couple of months, really since the July 31st high in the stock market, is the rise in interest rates out the Treasury curve. Not just the level, but the pace at which those rates have moved up. And that's been one of the real bugaboos for the stock market. It creates a valuation headwind is the right way to put it. Number 6, I also hinted at this. Corporate profit estimates remain too high. The consensus expecting earnings in 24 to be 11% higher than 23. You only get double-digit earnings gains when the economy accelerates and when you have lots of room for profit margin improvement. Profit margins are near all-time highs, and real GDP is likely to slow somewhat. Sentiment, which we've touched on in the first 2 seminars, really has no information at the moment. It's pretty neutral. 8, given interest rates and inflation where they are, stocks are, yes, down from where they were, but still expensive. And therefore, the risk reward is not real favorable, not even to mention all the domestic and geopolitical risks, the debt, the deficits, the war in the Middle East, as I mentioned, and all the other hotspots. So I don't want to come across as bearish. I might, given what I've just said, but I do lean to the cautious side. Let me leave it there, Evan.
Thanks, Bob. That brings us to Scott. Scott, can you help us understand a couple of things first? How is the current economy impacting private sector M&A? And second, how upcoming elections might impact M&A?
Absolutely, Evan. Appreciate Bob's commentary on all of this, and want to let him weigh in too if there's an opportunity. But actually, I want to kind of flip your questions and actually start with the election cycle, because I know that is now starting to get on the top of everyone's mind. And so I want to go all the way back into the ancient history of 2016. That's November of 2016 was when President Trump was elected. And actually, following his election, there was a noticeable surge in 2017 in deal volumes. In fact, you can see from this graph that using 2016 as a baseline, deal volumes went up by 18% in 2017. And also valuations increased as a result of a pro-business administration entering the White House. That, at least the sentiment that was there. And then, of course, fast forward to 2020. In 2020, we obviously had this little pandemic that happened, which caused M&A activity to slow down pretty significantly. It also had an impact on valuations as well. President Biden was then elected in November of 2020. And then after that election, deal volume surged to an even greater degree in 2021 than it did when President Trump was elected. And this was due largely to fears regarding the potential for a significant increase in capital gains taxes with the new administration. And so I mention these things really as far as how elections impact, M&A activity, to say that polar opposite outcomes both had a positive impact on deal volumes in the last 2 presidential election cycles. And so do I mention this to say that election cycles always cause deal volumes to rise? By no means. All I'm saying is that election cycles have impacted deal volumes in the recent past. I will say it's nearly impossible to forecast what impact they will have in 2024. But as you're looking forward to what happens, I imagine there will be some impact as a result of the 2024 elections. And that impact will be largely driven by the market's perception, not necessarily reality, but perception of a couple of things. One, how the new president will impact the economy and how the economy will evolve under the new president. And then secondly, how the new presidential administration will impact tax law. So those 2 things can definitely have an impact on M&A volume. I would also imagine that if an incumbent is reelected, that may have a more muted impact on M&A activity than if a challenger wins, right? Because it's it's something new information, right, that the market often responds to. Back to the first question, which was really about, not just elections, but how the overall economy is impacting deal volume. We talked about this in our first webinar back in August. No question that deal volumes and multiples are down this year. This chart would show 36%, which feels about right to me, largely due to economic uncertainty and interest rate hikes. In that first webinar, I did mention that the ice was starting to thaw on the deal world. At least that's what it felt like. And that really has turned out to be our experience over the last 8 weeks. We find that sellers are coming out of the woodwork and buyers are ready to buy after not putting much money to work over the first 3 quarters. Again, that's perception of interest rates kind of leveling off, if not potentially going down. And then, folks sort of pricing in either a soft landing or a mild recession. I did want to talk briefly about the fact that the credit markets are still challenging investors. As Bob said, it does help to have interest rates kind of more of a known quantity now. But the reality is that with that 5.25% interest rate hike, it does have a significant impact on lenders, especially commercial banks. And what the reality is that debt financing is really the grease that helps the private equity gears turn. Right? These guys are financial engineers. They're trying to engineer the highest possible return. And so engineering the highest possible return means using the lowest cost of capital to the extent that they can. And that means using bank debt. So the scenario outlined here illustrates the impacts of a $20 million deal, or how interest rates impact a $20 million deal in the pre-hike environment to the post-hike environment if we hold all other factors constant. And so basically on a $20 million purchase that's facilitated with $10 million of senior debt, it's likely that the buyer of the business would end up spending 7 months of additional cash flow just on interest payments over their typical hold period over the life of the loan, now versus the pre-interest rate hikes. And so those 7 months of cash flow that are going to pay for interest would have previously gone to other means, either growing the business, investments in growing new markets or fixed assets, things of that nature, or shareholder dividends. And so it would be foolish to think that that additional increase in cost of capital wouldn't have an impact on valuation. It does, and also deal structures. And so in particular, we are seeing a rise in more structured deals, meaning that we're seeing a rise in the use of earnouts, and also seller carry finance is increasing in our deal structures.
Great, Scott. So far, we've discussed how macroeconomic or environment may impact the sale process, but what are the other key factors that could influence the timing of a sale, and how do they compare to the macro environment as far as importance?
Yeah, thanks, Evan. It's always important to keep that in mind. I always talk about the optimal timing of an exit or a recapitalization as really a 3-legged stool. So the macro market dynamics that we've already discussed are one leg of that stool. The good news is that founders and entrepreneurs have significantly more influence and control over the other 2 legs of the stool. Those other 2 legs are the company's fundamentals and the continuity of the business in transition. is one leg, and then the other leg is really the shareholders' priorities and desires. And so if we take the second leg of the stool being the company's fundamentals and continuity, this leg of the stool really speaks to the attractiveness of the business asset. In our August webinar, we talked about a little bit about what does it mean to have an A+ asset, right? And at the end of the day, investors grade an asset based on two things: its scalability and the transferability of value in the future. And so scalability speaks to a wide range of things, including the financial performance, the margins, the growth rate, the infrastructure of the business, and the quality of the business's revenue. It's really the upside reward piece of the equation over the investment period. And then transferability of value really speaks to the risk that a business will suffer from the transition of ownership from the founder entrepreneur to the investor, right? And so that transferability of value risk really comes down to the continuity of the leadership and management of the business. And so investors tend to price in pretty significant risk when management wants to quickly transition out of the business after the deal happens. And so, this idea of, hey, I'm going to sell my business and leave the keys under the mat for the investor is typically not the best way to maximize the liquidity event. And in fact, maximizing the liquidity for the founder and entrepreneur is often done through what we call a two-step exit. Sellers often think their exit really is a binary thing. I'm either in or I'm out. However, there's a pretty significant spectrum between in versus out. And most of the time, private equity would love to see investor or sellers really have a two-step exit where they would prefer to buy majority control in the first step, meaning maybe they buy 70 to 80% of the equity, and then the partner with the existing management team who leaves 20 to 30% in the business for several years before selling a second time and creating the second bite opportunity. This can also be pretty attractive for the entrepreneur as well and create a nice outcome for them. The investor, so we have, again, two scenarios: the one-time exit where where the seller, the founder entrepreneur, basically sells roughly 100% and transitions out of the business quickly, versus a two-step exit where they sell 70 to 80% and then have a second bite. And so the investors are actually willing to pay more in upfront consideration on the first bite if they know that the entrepreneur continues to have skin in the game. Investors have more confidence in the future of the business. And we estimate that private equity will actually pay 15 to 25% more upfront in terms of valuation when an owner-operator rolls equity and continues to lead the business for 3 to 5 years. The other advantages for the entrepreneurs is oftentimes they are encumbered or constrained by their own willingness to make large bets when 100% of their net worth, more or less, is tied up in the business. And so entrepreneurs often have these step change growth ideas. And by taking some chips off the table in that first bite, but continuing to run the business, the entrepreneur is then empowered to make higher risk, higher reward decisions with a new partner that has deeper pockets to fund growth and expansion. And then, of course, the entrepreneur gets to participate in the significantly higher valuation when the second bite occurs. And we often find it's the case that a 20% equity reinvestment can yield more than the 80% initial liquidity that they got up front. So in this example, in scenario 2, the entrepreneur retains or reinvests 25% in the deal. They actually get, instead of a 6x valuation, they get a 7x valuation because of the perception that the entrepreneur continues to be invested in the outcome of the business and continues to run the business, creating that less transition risk. And so they get the higher upfront valuation. They roll roughly $5.8 million of equity, and they take out 17 million of cash in that upfront deal. But because they have equity alongside private equity in the second bite, private equity wants to see their returns, roughly a 3 to 4x cash on cash return on any money they put in. The entrepreneur participates alongside them, and their second bite in this scenario would end up yielding $20 million, which is more than the initial cash that they got in the first bite. And so, that is what we see happening with owners and entrepreneurs that sort of take a longer range view of their exit.
Great. Thanks for that, Scott. Allie, Scott mentioned that the third leg of the stool and timing an exit has to do with the owner's goals and mindset. Can you please speak to how the owner's personal readiness aspects, specifically, what trends are you seeing among business owners who are shifting from family succession or trying to grow their businesses to exploring an exit?
Yeah, Evan, I'm happy to. There's 3 big trends that we're seeing that are moving the needle. None of them are actually proactive. Most of them are reactive. It's fatigue, absence of a qualified successor, and market opportunity. And that relates a little bit to what advisors often refer to as the Cinderella syndrome. This is when owners have a business that's growing and about to peak. And in the fairy tale, Cinderella had a choice to make. She could get caught up in the excitement of being at the ball and dancing with the prince, risking her carriage turning back into a pumpkin and her beautiful gown turning into rags. And that's what she did. Or she could have left the ball at 10 p.m., arriving home safely with her stepmother and evil stepsisters none the wiser. Like Cinderella, many owners choose to stay in right up until midnight. The business is growing. It's making them feel good. They're rewarded. They have energy, and they're not seeing that leveling off or potentially even decline on the horizon. And we've seen this quite a lot with owners. That fatigue, having survived the pressures of the 2008 financial crisis, volatility in financial markets in 2011, the pandemic, as both Scott and Bob have talked about, and a lot of them are looking to make the pain go away. They don't have another round in them. So an exit looks like a good alternative for them. In family businesses, we're starting to see more and more an absence of a qualified successor. So they haven't prepared the next generation well, or the complexity that the business is facing doesn't match the skills in the next generation. And so sometimes that 2-bite option that Scott talked about, where you have a next generation has enough skills, they're willing to stay in, but you're not able to do it all at once. Sometimes that is a good alternative, but that absence of a qualified successor is definitely an increasing trend. And then market opportunity. As Scott shared, there was a rise in multiples that were being offered, and that made the enterprise value look really appealing. And when the pain is high and you have to solve for a whole bunch of variables to complete a family succession, if you can reduce the variables and take out a few of them and just focus on the exit, it makes it a lot easier, a lot more appetizing. Unfortunately, for those who waited, it's not quite as appetizing or appealing as it would have been several months ago. And Scott's chart spoke to that.
Great. Thanks, Allie. We're often surprised that business owners know that planning their exit is a good idea, but they still hesitate to do it. Or they know that they should use professional experts to optimize their transaction, but they still end up trying to sell the businesses on their own. In your experience, What keeps owners from taking the necessary steps to optimize their exit?
Yeah, there's really three common things. It could be a whole range of things, but the three that are most common are what we call a knowing doing gap, knowing you should do something but not taking action, a paradox of choice, and personality strengths becoming weaknesses. So we're going to unpack each of those one by one. So the first one is the knowing doing gap. And that's just because a person possesses information that is really compelling. It's completely rational and logical and tells them any rational person would say, I should take action. We should all have a funeral plan in place. We're all going to die and we don't know when it's coming. But if I asked everybody on this panel to raise your hands, if you've got a fully executed, paid for funeral plan in place, I bet we wouldn't have very many hands go up. That's the knowing doing gap. For owners, there's two interesting things, phenomenon that kind of drive it. One is perceived behavioral control, and that's one's belief related to required actions difficulty level. So things that are really, really difficult have a lower likelihood of us taking action against them. It's really a paralyzing feature that ties back to fight, flight, or freeze. If we don't know where to move to, we're just going to freeze until we have to act. And the second one is the Dunning-Kruger effect, and that's an individual's overestimation of their knowledge or ability. We'll see these later. The successful entrepreneurs are wired really uniquely, and these two things help to turn their personality strengths into weaknesses if they don't take proactive action to really understand what's happening in their world, in their inner world. So that's the knowing doing gap and two contributing factors. The next is the paradox of choice. And this is the concept that having too many choices is not better. It actually makes choosing harder. And the reason it makes choosing harder is similar to the knowing doing gap in that we don't know where to start. We get all kinds of competing priorities, and we don't know how to make a good quality decision. So in this case, for owners in your ecosystem, when your advisors are operating in a silo of their own discipline, you're more likely to go with the one that you have the closest relationship with, but it doesn't always mean that's the advisor who sees across the landscape in a way that can really help you navigate your journey well. It's a huge part of why we decided to do these webinars. And the third is entrepreneurial strengths that become weaknesses. So there are 5 entrepreneurial strengths that are more prevalent in successful owners. And when we think about that, what that definition of success means, it's owners that build a scalable, transferable business. So 96% of all entrepreneurs never exceed $1 million in revenue, never build a transferable, scalable business. Of that small 4% that do, these 5 traits tend to be very strong and prominent in varying combinations. The first is they have a very high need for goal achievement. They compete against themselves and everybody else, and status quo is never good enough. They have a tolerance for ambiguity. Every time they encounter a new level of business growth, they have to build scale into their business. They have to think and behave differently, and they can figure it out every single time. That is until they hit a ceiling. And then risk-taking propensity. This isn't like betting it all in Vegas on black or red. This is the propensity to take risks that owners perceive that they can control the outcome of. So when they're in control of their business, they'll bet a certain amount on a new product line even before it's completely proven. And they don't always have the need to do a full-blown market study like some public companies will do before they launch that new product. They'll have enough belief in it that they'll drive it out there and create a market for it. Steve Jobs in the early days of Apple and building the Mac is a classic example of that. And then they have high innovativeness. They see opportunities that other people don't see, and they create opportunities that other people can't create. And finally, a need for control. And this part of it is the difference between people who have an external loci of control or an internal loci. External, the world's doing stuff to me, I can't stop it. Internal, I can drive through obstacles with sheer force of will. I just keep going and try new things until I find a way over it. And so these are all absolutely essential for growing a business. They tend to be the antithesis of what we need to exit a business. We're not well wired to do that. We don't see it, first of all, as our own goal. Most often, when people tell us, take some chips off the table, de-risk our business, diversify our portfolio, we don't see that as necessary. And it's not our goal, it's an advisor's, even though it might be the smartest thing for us to do. Tolerance for every ambiguity. We don't believe that everything needs a plan. We've been able to figure it out as we went, and oftentimes how we're wired is to be able to see the big picture and not prioritize details. Risk-taking propensity. We don't see delays as risk. But we just don't see the delay. So for a lot of owners who are now looking at, why can I get those higher multiples that they were getting 9, 12 months ago? Well, that delay was risky. We just didn't see it. We were blind to it until we were on the other side. Innovativeness. I've always found solutions when I need them. Why won't I this time? And this is the space where time is not going to be our friend. The sooner we plan for our financial investment outside the business or for the sale of our business, the more options we have. The closer we get to that event, the fewer options we have. And the last thing is, where our need for control comes in, is we go to a space where we feel competent and comfortable, and we know that we're going to put out effort and get some return for it. And we feel like the captain of our ship. When we go into these spaces, either to work with Bob in figuring out our financial portfolio or with Scott figuring out the future of our business transaction, we now are working with a lot of advisors who speak a lot of different languages that we don't speak. And our need for control creates a sense of fear that we don't always know about because it's happening below the surface. So owners are used to doing things their way, being capable of figuring things out and pushing through barriers. Why would the exit season of their business be any different? Except that it is. And some only find out after they've struggled or worse, exited and regret the exit. And so our admonition to you is really to leverage your psychology and keep it a strength, and take what Bob and Scott are sharing with you and don't just file it on a drawer somewhere. We're going to send out the deck, go through the slides, and really look at your own business environment and personal environment and decide where you want to start.
Following Allie's insights here, I have 2 questions for you. When it comes to owners assessing market conditions in this 3-legged stool, should owners try to time the market? And second, can you share some tips for owners likely to experience a liquidity event in the next 6 to 12 months and navigating the wealth and asset strategy landscape for?
Sure. Timing the market, people have been trying to do that for centuries, and it's a random walk. Not only in the public markets, but let's suppose you know the exact day that the value of your business is going to peak. You can't for sure know you're going to sell it on that day. It's a process. All the players that come into being to get it right, the inevitable delays and rabbit trails you're going to go on as you move from, as Ali has appropriately put it, a position where you feel like you control almost everything, to when you get the other side, you're going to feel like you control almost nothing. And that adjustment is not easy for people. I know I see it in the business that I'm in. If somebody has a concentrated stock position, it's because they work somewhere for 30 years and that's their 90% of their wealth, or their parents passed on some huge stock position. Parting with that is far more emotional than it is rational. And so having the ability to trust others, to recognize there are no specific best dates to do anything, We talk about it in the public markets as a dollar cost averaging process. You can't always sell your business, over a period of time, but when you get the proceeds and decide to put in a long-term plan for yourself, your family, and your heirs, there's nothing to say you've got to do it on a particular day. You're going to spread it out over time. So I think timing the market, again, people have tried it. Most have failed. I've observed people that get it right are lucky, and the next time they don't get it right, because it's a lot smarter than we all are, and there's so many variables. If in fact, however, you're on the precipice of doing it, and you're thinking about what am I going to do in the next 3, 6, 9, 12 months, that's a process as well. Let's suppose you're going to get $25 million for your business. The day that check comes, and chances are it's not going to be one check on a particular day anyway, it's going to be a staged transaction, but let's suppose it is. It's not as if that day you're going to say 25 million, here it is, put it in the stock market. You're going to have a process whereby that happens over time. We use the phrase dollar cost averaging. So this notion of trying to find the right day or the right month or the right quarter, good luck. And if you get it right, give me a call.
Awesome. Scott, do you have anything to add to Bob's answers there?
Yeah, if I go back to the three-legged stool, right? In really thinking about, even in the context of really making any decision about the business, whether it's entering a new market or, figuring out what your competitors are doing, right? Really, if you're thinking about the future, right, spend 90% of your time planning for, strategizing on things that you can influence or control, and only 10% on those that you can't, right? And so it's not to ignore those outside macro factors, but it's to really reduce the time you spend thinking on those into if you work on building an A+ business, right? The exit will take care of itself. Right now, what we're hearing from private equity is, man, if we're seeing really solid assets in the market, the multiples are potentially even higher than they were 9 to 12 months ago, because there's such a scarcity of those assets. And other deals with B level assets, C+ level assets just aren't even getting done.
Wow. Well, Ali, Scott, and Bob, we've covered a lot of ground in this webinar. And before we open it up to some Q&A, I have one last question for each of you. If you can impress one thing upon business owners and their advisors to take away, what would it be? Bob, would you be willing to start?
Sure. I'm repeating some of the things we've talked about, and that is have a rational, open mind. The emotions are going to creep in. I know even when I've switched jobs in the same business I'm in, the uncertainty of the new environment can weigh on you. And I can only imagine somebody who's built a business over a lifetime and then has to move on to what's next, the anxiety of, now what am I going to do when I get up in the morning? The market went down and I'm invested. What's wrong with my financial advisor? I mean, the questions and the uncertainties, moving from a position of where you think you're in control to a situation where you're not in control, is really challenging, and don't let it get to you.
Great. Scott, what about you?
Yeah, I would really just say, Evan, don't wait until you're ready to retire to consider recapitalizing the business, right? If you think about the two-step exit approach, you can often have a lot of fun with that as well, right? Where in that last quarter-mile stretch of your career, you, again, as opposed to sort of just having the business on cruise control and kind of waiting things out, it's actually, you can have a really fun season, really focused again on growth and getting the business, to a level that you never thought possible. If you do recapitalize and you're with a partner that has significant deep pockets, to continue to grow the business.
What about you, Allie?
I'd say think about the luck equation. That's luck equals when preparedness meets opportunity. And you can't control the opportunity, but you can control your preparedness and the preparedness of your business. So don't let your psychology make it your superpower. Don't let it get used against you.
Great, thank you. So with that, we're going to open it up to some Q&A.
And they can use the Q&A feature if you just click on that and type your questions in. We have a couple in here, Evan. So if it's okay with you, I'm going to jump to those.
Go for it.
And oh, never mind. They were technical questions. They were just logistics questions. So go ahead with the questions you have.
Okay, so the first one here is for Scott. So how do you know when to go to market?
Yeah, that's a multifaceted question for sure, right? And again, the three-legged stool, you've got the performance of your business, right? So hopefully it's growing, the margins are good. It's not good to, if you can avoid it, going to market when your business is declining, right? Second is, those macro aspects, right? So if right now, when we talk to consumer products businesses, if your business is heavily reliant on consumer discretionary spending, and we're talking about a recession where consumer balance sheets are weak, okay, then that would maybe not be a good time. And then lastly, right, is your personal priorities, right? And the reality is, if the timing is right for you, and the liquidity that's expected from the transaction is more than what you really need in your life, then you shouldn't let really the continued increase of the valuation, you shouldn't need to worry about that as much, right? You should focus on the other things in your life that are really important to you.
We have a question in the chat. What are the key drivers of value creation while in the M&A process, Scott?
Yeah, really good question. The key drivers of value creation. And it's within the M&A process, Allie?
That's the question, correct. Okay. So you're already in the process. Right. What's the opportunity for value creation at that point?
Yeah, I think I would sort of take that question by saying, one is, what the process really does for you is create optionality, significant optionality, right? So it's really telling a really good story about the business, right? What is the moat of the business? What are its strengths, and how can those strengths be leveraged to scale in the future, to create a lot of options with a lot of different types of investors, because I look at the value that the entrepreneur gets as multifaceted, not just, what did I maximize my cash at close, right? Of course you want to do that. But in terms of value creation for the entrepreneur, value creation oftentimes also means the certainty of getting the deal done, right? And the fact that I didn't waste time not getting a deal done. And then thirdly, does it allow me to do in the future chapters of my life what I want to do and what I'm excited about doing? So I guess that's how I'd respond.
Bob, anything to add to that one?
No, I think that was a good answer. Look, until the transaction closes, building value is always a good thing. It's only going to help your case. Don't think that by the time you've all decided you're going to do it, you can kind of sit back and plan the rest of your life, although you should be doing some of that. You've got to work until the 12th hour to maximize that value.
think that's really well said. When owners get distracted, instead of value creation, we get value reduction for sure.
Ali, we had
Yeah.
some owners one time where ahead of the closing, they had already started putting some money against some new property, some really expensive vehicles, and then, you know, at the sort of in the 11th hour, the buyer came back and said, we want to decrease the purchase price by 15-20%. And the entrepreneurs had really diminished their ability to say no,
Yeah.
you know, to that because of some of those things they had done.
And that's an example of their psychology working against them. They didn't have anybody that was helping them explore really good decisions and being comfortable in the delay. We have another question. We have a CPG company that is about 28 million in revenue this year. It's break even. That is growing to almost 40 million with 3 to 5 million in EBITDA next year. We think we can see another big jump from 24 to 25, but the management team also feels like next year might be the year to sell. What do you and your panelists think? So I'm going to start and close that one. I'm going to start by saying, if you're thinking about an exit, you need to talk to Bob. One of the most important steps you can do early is plan for your post-exit liquidity and what you're going to do with it. And then I'm going to hand it over to Scott and Bob to give their perspectives on that.
I'll jump in.
Go ahead, Bob.
Look, if you think you're going to move from a break even to a noticeable profitability, and the next year even more, it sounds to me like there's a lot of value creation happening during the 24-25 period. So unless there are other reasons you need to move and want to move and sell sooner, maybe you just wait a bit and try to recognize that value and get some more out of it. That's my first reaction.
Scott?
Yeah, I mean, the devil is in the details, but for sure, cash flow is king right now, right? And so the ability to demonstrate margin improvement and have that actually on the books is will certainly create a significantly better outcome. As Ali alluded to earlier, right? You know, Cinderella could have left the dance at 10 p.m. and been better off. So, you know, that doesn't mean leave at 3 p.m., right? You know, you want to leave some growth on the business, but for sure, if you can demonstrate significant positive cash flow ahead of the sale, that will yield a much better outcome.
And I agree. The two things I'd encourage you to think about are, don't wait to plan. So if you think you're heading towards 10 o'clock in 2025, now's a great time to make sure you have alignment among all of your shareholders for what you want for three things. And it's a definition of MOM, what you want from management, ownership, money, and then yourselves. And make sure there's alignment among shareholders before you go in. The second thing is, if you're having that much scale, you need to build a really quality management team, make sure they're well resourced. And if you're looking to exit, make sure you have a great succession plan for all of your key leaders. I think it sounds like a perfect opportunity for you to think about Scott's proposition, to think about two-stepping your exit. And so if growth capital is going to be necessary and you can see a pathway to a partnership, an investor coming in, that might want to be something that you explore maybe after you've realized this first step of growth. What do you think about that, Scott?
100%, Ali.
Awesome. All right, we have about 6 minutes left. Any other questions? Oh, I have a big old thank you, you guys, from that owner. Any other questions, Evan, on our list?
Yep, we've got one for Bob here. So financial advisors have continuity of relationship throughout the transaction. So ideally before, during, and after. Bob, what do you experience owners struggle with most 12 to 24 months after their liquidity event?
Wow, it all depends obviously on the set of circumstances. I've met some who second guess. Should I have really done this? Did I do it at the right time? Instead of saying did and done, I made a bunch of money I never thought I would. Let me do the best I can. So that's one reaction. Another reaction is I alluded to this before, just discomfort with the day to day. I'm used to getting up at 6, going to the office at 7:30, and I know what to do when I get there, and I know how to get the best out of my people. I love my clients. Now I've sold the business. I have no idea what to do when the alarm rings at 6 o'clock. So lots of that sort of figuring out. And that's why, back to what Alia said, plan it, think about it. What am I going to do the next day, as it were? So I don't have those periods of discomfort. And then the third is, I hear this a lot. I wish I had planned. I wish I'd figured some of these things out. Back to the basic stuff of, I use my illustration, 25 million. Are we all in agreement? What about the people that are going to get the money? Are they all on the same page about where it's going to go? So the more you think about and plan ahead while you're still running your business, the better off you're going to be on the other side.
All right, and we have one more in the chat, Ali, but before we get to that, same question for you. From your perspective, what can owners do to address these challenges?
I echo what Bob said. It's really is a hard thing to be, think, and do differently. And some really interesting research out of Institute for the Future related to the pandemic. They predicted it well in advance, back in, I believe, 2009, even to the point of airborne virus coming out of China through one of their gamification scenarios. What the research found is that the people who lived out that scenarios were better prepared. They imagined the worst case that it could be, knew they were going to live through it. And so when it really happened to them, they had much less anxiety than the general public. For owners who are thinking about going through a significant transition, whether that's full sale, partial sale, or family succession, really playing that out and not just glossing over the implications will have a huge benefit for you.
Great, thank you. And we have one more question in the chat I think we can answer in time.
Go for it.
How has investor/buyer due diligence changed over the past 12 months, given uncertainty in the macro market?
Scott, that's yours.
It's elongated for sure. I think, particularly back to comments about what's going on in the credit markets, it sort of used to be that private equity would really do the diligence, and then the lenders would sort of just check the box and sort of review what the private equity firm had done and move on. We're seeing that no, the lenders are really doing a lot more of their own due diligence. They're pressure testing the numbers a lot more on their own. And so, what used to take 60 days is taking 120 days. That's part of the reality of the current market environment.
And owners are getting tired and frustrated in the process.
Yeah, even more so than they normally do.
Yeah, they've got to really prepare for that. Fabulous. Well, Scott, Bob, it has been an absolute privilege to work with you guys in serving owners as a team instead of as siloed advisors. I think that is the key to really serving owners well. So this is the third in our 3-part series. We will be sending out links to everybody who registered to this webinar, plus the deck, and links to the first 2 webinars. You can reach Bob, Scott, or I. Our contact details will be in the deck. If you're thinking about a transition, it is not too early to reach out. Even if you're 3, 5, 7 years out, we're all happy to have a conversation with you with no risk and no commitment or obligation. We really are here to support. Bob, Scott, anything you'd add to that?
Echo it. Well done.
Thanks so much, Ali and Bob.
Thanks, guys. Have a great day.
Bye.
Thanks, Evan.
Yep.